Okay, welcome back, everyone. I want to start off by I have a couple of topics I want to get into today. So I want people to think about these topics. And this is, the Mulvaney interview, which I haven't been able to comment on yet because the sound coming from Paul was particularly bad. My ways of recording, which are low tech, they are not great at recording English UK speakers, that dialect, that accent. And plus, so when it gets out on YouTube, it will should be a pretty decent transcript. And I will tweet some stuff there. But one of the things I was interested in, and was one of his statements, certainly not the most important or most interesting statement, but I've heard this before, and I need Richard and others to comment on this. And it was this idea that eventually the drawdown for trend followers, I guess, or for him, or for trend following, will be 100%. And I'm like, that's pretty sad. And I don't think that's true. I don't think it's true. But I've heard it from others as well. And so eventually, if we trade long enough, we're going to lose all of our money. That doesn't sound too good. And that would probably, if I believe that, alter my strategy for the future. Okay, so I think that's a pretty interesting topic to talk about. Maybe I hopefully might have misinterpreted that. Yeah. So, anyways, I won't go any further. I'll let you guys think about that one. I was going to talk about the markets a little bit. The super cycle commodities is a bit delayed. The dollar bull market stand, and I'm positioned for about a half or 2/3 of my currencies, assuming that the dollar is going to keep going down. It's just strictly based on trend, but that's delayed as well. Peak inflation, peak rates, a bit delayed, it seems. Stocks, yeah. I'm following these stocks and I read these things about CTAs are very long, but hedge funds are very short. So I don't know what's going on in stocks. I think it's pretty much longs, mostly longs and indices, I think, and probably for me as well in the single stocks, mostly long. I don't think it's difficult to find short. I think I might notice that some of the Chinese indices are still technically shortish, but I think it's tough to find short indices these days. So they're pretty much easier to find long indices. Okay, Oleg, are you ready?
Yes. Hi, Jerry. Hi, Marit. Hi, Richard. Hi, Brian, Bruno. Hi, all the guys. Alp, of course. Josh, our Jerry Smith. Our new friend here, Josh. Very glad to see you also. So, of course, I was waiting all the week, every day. I was from morning to night. I was waiting our trend following trading conversations. I was thinking about trend following, and I'm almost every day I think about trend following for many years. And almost every day I understand there is nothing more perfect, maybe more safest in investing in trading. And I have said many times, and I think that we copy, we use, we apply the laws of nature. And when I look at the mountains, I look at the maybe even in the chart or in the weather chart and all charts, and I understand that if, for example, a weather chart would be a chart of Great British Pound, United States dollar, and I will apply trend following model to this chart, it will be profitable. And for me, it is a very big evidence that trend following is perfect. And I'm sure that it will always be working. I'm absolutely sure, 100%. And of course, but it must be, of course, classical way of trend following. So 100%, I'm sure that I'll be okay with trend following. So let's get started. Very happy to be here as always.
Hey everybody, just wanted to comment real quick on the minus 100% drawdown. I listened to the interview, 45 minutes, one of the shorter ones. Yes, a little bit difficult to understand, Paul at times, but I think what he said theoretically, the worst drawdown is minus 100%, and that statement is obviously correct. I mean, theoretically, yes, minus 100% is the drawdown. And then he said there could be an event in the markets tomorrow that puts us out of business. So yeah, you could think about, I mean, how many markets does that have to happen at the same time? They all need to massively gap against you. Sure, I mean, it could be a massive loss, a very large drawdown. But practically, like, given the fact that we're long and short, we have all these different markets. They're not doing all the same things at the same time. We don't have the same direction on. So practically, um, jumping to a minus 100% drawdown, or going to that minus, like losing all your money trend following, I would just say that is just that is so unlikely. Maybe even impossible. I don't want to say impossible, but it's just not something that is a practical reality that I would worry about. If I did, then I kind of like would have to question myself, like, why am I trading this way? I don't think that is really a big risk, or a risk at all that we should be concerned about, and therefore, yes, theoretically, it is possible. But look, I mean, OJ would have to kind of like drop to zero in one go now, and the bonds would have to shoot up to whatever, like 200, all at the same time. And yeah, I mean, if that happens, my portfolio is going to have a major problem, but still not probably going to be at minus 100. Um, so yeah, I would just fake that a bit and discount it. I think it just meant a theoretical. I wouldn't mention it in that way to any prospective investor or client. I think you're just scaring people off. I'd rather focus on the protectiveness and the diversification, and the fact that you're actually more secure with your portfolio when you trade our strategies, as opposed to having something that is long only buy and hope. So the drawdowns that you see in the S&P 500 and some of the others, just long only, always directional, same direction type of investments. I mean, these drawdowns are larger than what we have. So yeah, that's my view on that.
I think, ironically, I think that it is probably impossible for the S&P to go to zero. Um, Even if we had some crazy event in the world, someone would be sitting around with some sort of bid to eventually, I don't know, maybe they would all go bankrupt, and so you would lose it all. But yeah, I think that's good advice, not to mention this to clients. So I'm getting ready to start this ETF. I won't go on the road and tell people that it can all go to zero. But I do think I've heard other people sort of say this, and I don't understand. But I think with leverage that we use, it can spin out of control. So I think a cash only, it'll definitely continue to have the S&P, let's say, be prone to bigger 50, 60, 70% drawdowns. And we will try, and we can easily avoid that with our leverage choice and our markets and our shorts and our diversification, our systems. Um, but I do think at the same time, something could absolutely happen with even with the diversified CTA portfolio that is leveraged to it a bit. So to the degree that the S&P is not leveraged at all, it's probably much harder to go to zero, but much more frequently that it could go to minus 50 or 60 or 70. But I think from day one in the turtle class, this was an issue. This was an issue. Like, we don't want this. I remember them asking us, what do you think is an acceptable risk of ruin? Now, we didn't know anything at this point. This was like the first few days, right? So, and we still, even after the first few days, we didn't really know a great deal. And so, not compared to those guys. So, um, So we would say maybe like 1% or 2%. But I think their answer was, oh no, something incredibly small, a very, very small number, way less than 1%. So now I think the way to get their methodology for ensuring that this would be the case was the calculation of the trade level, which does not equal your current AUM. You do not keep trading, taking bigger and bigger trades. The more money you have, or the more open profit you have. And so this is a no-no. This is how the compounding can work against you. And then number two, of course, was the cutback rule, where you cut back twice as much as you're losing. So if you're down 10%, you trade 20% smaller. If you're down 20%, you trade 40% smaller. So this sort of cutback, they were very concerned. And now we were trading much larger, and we were making 200% a year with massive drawdowns. So this was more of a concern. But I think that with issues like that, it would maybe, with those extra rules added, I think this would make it less possible. But I think there are people out there who definitely believe that it's just inevitable. It's more like, I think it's building on this idea of your worst drawdown is in the future. So that's another thing that I think people have said. Usually it's people I'm friends with, and I don't really say too much, but I don't understand that as well. It's inevitable that it's in the future. I mean, it might be in the future, but it's definitely going to be in the future. And I think there's something there I'm missing. What do you think, Richard?
Yeah, well, I tend to throw a spanner in the works here because over large enough sample sizes, anything is possible. So, my thoughts are that traditionally, trend following, we've seen over the last 30 years, we've seen drawdowns in the 1980s to 1990s, probably back tests, etc., probably accepting drawdowns of, say, 20, 25% or whatever. But then we see in 2010 through to 2019, some of the CTAs had their worst drawdowns on record of up to 50%. And they might not have necessarily expected that result, but it was an outcome of just a particular regime that was very unfavourable for them. So the way I view very large populations of data, I do have to accept that there is always a chance of risk of ruin, no matter how safe you feel your strategy is. There is a combination of events that could occur, it's possible, that could put you out of action. So when you look at the probability of that, it's vanishingly small. But as your sample size grows larger and larger and larger, there is always that possibility of that outcome. So I tend to view any trading strategy as necessarily having a finite life cycle. Risk of ruin to me is an inevitability over very large trade samples. However, what I'd say is it's not necessarily a fact associated with a generation of traders, but it might be found over 10 generations of traders doing the same system. If you get a sufficient enough sample size, there is likely to be an occurrence of an event or a contingent sequence of events that does put you out of action. Now, it might not necessarily be a immediate risk of ruin event where everything suddenly turns on a pin. It could be the consequence of, say, 40, 50 years of volatility suppression, which no sort of outliers being found over that period. It is possible, and it might be a slow death by 1,000 cuts, even with some of our drawdown mitigation methods that we do. But I tend to always view things that there is no system in this world that is permanent. There's no system in this world that has an infinite duration. Everything is ephemeral. Over the course of time, there will be, these events potentially in the landscape of future possible events where we certainly could get this happening. But I do think that I agree with Moritz in that the processes we adopt with trend following are so much more robust than other trend following methods. I think the last people surviving will necessarily be probably the trend followers, but I certainly think that trend followers themselves shouldn't get too cocky and assume that they're here forever.
Hey, hi everyone.
And I want to say that.
Yeah, glad to be here too. I guess this discussion of the inevitable 100% drawdown and that the worst drawdown is ahead of you. I think it's not a practical discussion, just as Morris was pointing. It reminds me of a documentary on Netflix about the infinite. That's pretty interesting, by the way. I recommend you all to watch it. And the thing is, if something is possible, if an event is possible, and you take an infinite number of instances that they may happen, it's certain that at least once it will happen. It's a mathematical truth. And the thing is, if you take an infinite amount of time ahead of you, it's certain that you will come across ruin, because the risk of ruin is not zero. It's positive. It's incredibly small, but it's positive. But it may take hundreds of years. It may take millions of years. Who knows? So that's why I say it's not a practical discussion. But yeah, we don't have a way to prevent risk of ruin. It is possible. It's just like Jerry suggested. It's way less than 1% chance, but it may happen. It just may take a huge amount of time that may take generations of ahead of us for it to happen with a trend following system.
And I have said today that I think that I'm sure that we apply the general laws of nature. And when I see mountains, when I see weather charts, and so on and so forth, I'm going to be even more confident in my trend following system. 100%, I am sure that it's unbeatable, and it always will be working. I'm sure 100%, but it must be doing in a proper way. It must be a classical trend following from medium to long term, and I'm absolutely sure that it will be working. I'm sure, because I see the evidence in nature.
Yeah, I didn't mean to say that it's 1% risk of ruin. I don't know what it is, but I'd say that they were asking us what's acceptable, and maybe someone was like 1%, 2%, but I don't think that is acceptable. If it is that high, I think if you know that it's that high, even before you get this once in a lifetime issue with your system, war or something, plague or whatever, then that is a problem. But even if it's close to zero or humanly possible, measurable, very as close to zero as possible, it is still out there and prevalent. Good morning, Alp. You got anything to add to all this?
Hey, Jerry. Hey, everyone. I mean, you know, I always refer back what Elon Musk talks about, isn't it? He's, someone needs to be crazy enough to do things that are a little bit out of the box. And there are not many people actually who plan for, multiplanetary lifestyle for human species, isn't it? He has objections and dreams and vision to be able to, at some point take the human race to Mars. So when I was listening to him, he usually talks about it like a fire exit. In every building, in every skyscraper in London, we have a fire exit, and it is mandatory to have a fire exit. And the way I understand him is to be able to colonize in Mars is a fire exit from the planet Earth. So, so there are lots of small probability events that might trigger needs to do systemic risk, and not only trend following, but nothing works. We might just we just need to think about the extreme cases, I guess. And since there is a very a known personality working on this, I think it's just and so that's one way of looking into it. And there are other black swan events, isn't it? Like a war might lead to a shutdown of financial markets, not permanently, but let's say temporarily and long enough to be able to wipe some of us out. Will you be able to survive if financial markets close a month or 2 months or 3 months or for a year? Let's say there's a nuclear war or any other kind of war that actually the American markets are closed. What are you going to do then? So that's definitely a more plausible scenario, I guess. The temporary shutdown of the markets, because we need this liquidity all the time. But if the markets are closed for a considerable period of time, and then you might end up with the gap risk that the Moritz was talking about. And of course, the other option is, we don't know what's going to happen in the next 20 million years, do we? So with that perspective, if the far left wins, for instance, politically, there might not be any markets. So that's another way of looking into it. So the markets may totally be closed. So there are things like that, like COVID, another biological terror. So yeah, it's not only the end of trend following, but it's more of an end of the markets, or there is something else worse happening. And the more I listen to Elon Musk, and the more he talks about this preservation of consciousness, and we shouldn't be taking it for granted. I think there is some room for thinking and for planning a fire exit for us as well. Thanks a lot.
Yeah, that's an interesting one. Perhaps the risk of ruin for trend following is not zero, but it happens only after something much worse from our perspective happens. Perhaps it outlives ourselves. So what's the point in thinking of risk of ruin for trend following if it's happening only after we're not here anymore?
Yes, that would make me feel better. Somewhat better, I suppose. Not perfect, but certainly much better. Although I want to set up my system in my trading, and maybe this will be more possible with this new ETF, which I'm not allowed to talk about. So I had to take down the TFPN from my Twitter bio, and so I'm not supposed to talk about it until it comes out. Covell invited me to be on his podcast soon, and then he was going to release it right after the ETF comes out. But maybe this ETF fits in with my idea that I will want my trading and track record to live on for hundreds and hundreds of years, because basically I want my style of trend following to live on. And so maybe I can set up a computer, and then I'll have this ETF that someone can keep running, and I'll have my systems all coded. And so I guess I'll be worried about that on my deathbed. That, oh God, I am not going to witness necessarily this demise of classic trend following, but I have set up someone else to feel this like pain or whatever. Another thing I wanted to go ahead.
No, I was just saying, Jerry, you could just replicate yourself on silicon, and we could have an AI Jerry. Maybe we could make you a little bit more socially palatable as well, and you could live on forever, brother.
Wow, I'm not socially palatable. Okay, all right.
Hey, shots fired early in the morning. I'm just kidding.
That's like typical quantitative greasing. He just goes like one sentence too much. Yeah. Oh, another thing I wanted to bring up was how much I enjoyed Maritz's podcast with RCM, and that was a really good one. I really enjoyed listening to all of that. I'm looking forward to the new fund and all of that stuff. So, but I wasn't I had to say something a bit negative about, I guess Jeff was saying, oh, yeah, I tweeted negative stuff about this, even though I like Jeff a lot, and he's really super smart and super funny. Yeah. But I didn't like that idea that, you have to do vol management because clients won't put up with it, and it's, not a good business idea, and blah, blah, blah. So I think that's, hopefully 100% wrong, because my whole reason for existing is that, with very consistent performance and great performance, and frankly, if you do these things you shouldn't be doing, like vol management, correlation management, if the performance isn't worse, then what's the point, right? And so I think the performance is worse. It's only arguable if you sort of throw in other things that are irrelevant, like sharp and smoothness. And so hopefully the next 10 or 20 years the classic trend following strategy will be implemented by some people, and you'll have something to compare with, and we'll be able to sort of see it in real life versus just in back testing, how much better and superior one entry and one exit and the stop loss is.
So, is it possible to discuss this, Jerry? A question. This fixed portfolio. I do have a question for you. This fixed portfolio. On the short side, now I'm adding these large caps to be able to short because I believe they are making much more sense than shorting the indices. But there are times that you would want to incorporate, more large caps to be able to, in tune with what is happening at that moment in time. So, Credit Suisse is a very good example. It's one of those large caps that actually has managed to go to zero. So it makes a huge difference in my back tests whether you're shorting Credit Suisse at some point or not. And because it is a large cap, it is easier to capture it in the original portfolio. So it's not like you're trying to predict, SVB, Silicon Valley Bank. So that is a medium-sized bank. So it is difficult to capture that in a portfolio, but not Credit Suisse. So, so what is your thoughts about, just incorporating new short possibilities into the portfolio? Of course, this means that, you need to be open in extending that portfolio, or does this sound like a fixed portfolio, or how does fixed portfolio works for shorts, where opportunities for shorts just are actually in pockets and come and go? For instance, in COVID, the short opportunities were totally different. The companies that have suffered financially were very different than what has happened in 2022 and in 2023. So, I'm just curious to understand your thoughts on that. Thanks a lot.
Right. This is not a subject that I hear too many people talk about. I can't even disagree with managed futures CTAs because I don't think they talk about it. So I think having a fixed portfolio is important because you want to have a consistent application of your systems, right? Yeah, we're going to follow these systems, and we're going to recognize minimally that there is a cost to changing systems. Sometimes you have to do it. Back in the late 90s, I was trading too short term, so we we decided to go longer term, and we did the research, and that research and what we found hasn't really changed. It was better to be long term in the 100-day plus look back, not too long term, but you didn't want to get probably any closer than a 100-day look back. So you want this consistent application of these systems against a consistent group of markets. Now, as things get better for us, because diversification is so important, and we're opening up to China commodities, single stocks. There's new futures markets, emissions, all coming on all the time. There are new currencies. Our portfolio AUM grows. We can start trading more and more markets, so the portfolio can expand. It's not going to be fixed in that way, but maybe from now on, we're going to keep these new markets in, if at all possible. Some futures markets and I guess stocks do go away. And then if you want to take out something, if you want to, you say, okay, I understand, I'm going to trade cocoa, and it has lost money for 20 years or is never made money in the back test. But I understand why you want to trade it, but I'm going to take it out. I think that's fine. You just take it out. Just don't take it out and then put it back in, and then take it out again and put it back in. So as far as just this consistency and discipline, everyone's on board with, yeah, we're going to follow the system. Yeah, we understand that there's a cost of not following the system. Oh, I have to have a fixed universe as well? Yes, I think you should think about that, and I think that's important. You should have this fixed universe, but given the caveats I've just mentioned. So it's all about this consistency application of the rules. The trend followers are not going out there and saying, oh, what's the latest thing of the day? SVB. Well, then find the banks. Then let's go trend following. No. That's half-assed trend following. It's like trend following overlay on a lot of discretion. So what you want to do, what we're kind of limited into doing, and I've mentioned this 1,000 times on this podcast, and on this spaces and on podcasts and everywhere. What you want to do is you want to choose the markets based upon diversification. So you know what? If you got a couple of bank stocks in there as your shorts, then great. Then hopefully, you got the right ones. If you don't trade bank stocks and you say, oh, that's a mistake, I need to have that sector in there for longs and shorts, then I promise I'm not doing anything illegitimate here. I just realized I made a mistake. I need some banks. I need some other things too. I'm finally understanding that I need more diversification in my stock sector. Then throw them in there. And then if they happen to be a good call during this particular period, so be it. But we're not targeting fundamentals no more than we're targeting in the futures, in the commodities, in the currencies, in the interest rates. We're adding markets because we're thirsty for more diversification. And then we're reducing the overall risk for each market as we keep adding. When I've gone from 150 to 300 markets, I've cut my risk per trade in half because I've doubled the market. So we're playing a game, and we're not really paying that much attention to what is in the headlines and here's an opportunity. Now, opportunities we have are certainly limited versus discretion or what's in the headlines. I kind of just ran out. I think that was an amazingly A+ answer, but maybe it wasn't that clear. I could probably think of some other things as well, but feel free to push back.
Hey, I'd like to add some perspective
Yeah,
here.
I fully agree with all that Jerry said, and I want to say that I think that every systematic approach in all fields require consistency. We can't have something systematic and robust without a consistency. So this, like as Jerry said, that we must do the same things in the same circumstances, and it's very, very important.
Hey, I'd like to add some perspective here. I trade the longer term trend following type of systems, and I've been running them for about 2 years. And around 1 year ago, I enlarged my look back periods, so I had this change in the system parameters. And right when I changed them, I decided to go only on the new trades the system told me to go. So the old trends, so to speak, I was not on them. I was only going on new trades. And it took some time for my system to look like the other trend followers around, the other longer term trend followers around. So I guess this change of system parameters, this change of this lack of consistency, has cost me the similarity with other trend followers that supposedly are running with the trends in the markets. I believe that this can be applied to this ad or this ad or of new markets or change of your universe. If you're adding and subtracting markets from your universe, you're running the risk of not taking the trends as you wanted to get them. The reason I was my performance was not looking much like other trend followers was that I wasn't in some new breakouts that were coming out, and most of trend followers that were around before me, they were in these trends much had come in much before me, so their positions were different than mine. They were perhaps larger than I was because I got in the trend much later in time when the ATR was much larger. And so when you're adding new markets, perhaps you're getting the signal of a new trend that was already there much long ago. And if you wanted to run a longer term system, you shouldn't be in at that point in time, but actually much before. So I think this is just an example of why this lack of consistency can cost you. I know you run a shorter term trend following out, and I'm not sure this would apply for you, but I think this perspective might give you some ideas.
Yes, actually, thanks, Bruno. Yes, of course, I totally agree. Consistency is hugely critical. Now, from the things that we've been discussing here for some time, this particular type of trading, which we call classic trend trading, has a specific property of hunting those outliers, right? Richard Brennan has made this famous, and I think it just makes sense. So we actually go and aim to hunt those outliers in the distribution, and I do it on my own time frame while trading hourly bars. I hunt those outliers, and some other people, the majority of the people in this forum would do that in daily bars. Now, but the philosophy is the same. The principle is the hunting those outliers. Now, I've listened carefully what Jerry has said, that he wasn't just very favor of the discretion element or responding to the fundamentals, but which principle we actually do we prioritize is the question. I mean, is there any virtue in what we do that is more important than hunting outliers? If let's say
I think that is there any virtue more important than being 1,000% consistent?
right. So what happens is, okay, in the times of the COVID is a very good example because it's such a unique times that we've experienced in our lifetimes. And during COVID, we've been just suffering this, this flu, and there has been few pharmaceuticals have been elected by the U.S. administration, and that one of those companies or one or more of those companies is actually going to come up with the vaccine. And even just before, even before that Project Warp Speed or whatever the name was, so adding Moderna, who were the winners of COVID at that moment in time, and you could have actually captured quite a bit of outliers by adding Moderna and adding other relevant pharmaceuticals. So if I wouldn't have the Moderna in my portfolio, and if I'm in the middle of COVID, it may just make sense. It's not about a short term or a medium term or a long term discussion, but while catching those outliers, and I'm not saying that just bring it on, 50 stocks like that, but maybe 4 or 5, just to be able to respond to the black swan that is happening at that moment in time, to be able to catch those outliers, because consistency requires us. Why? Because why do we want to be consistent? Because we want to achieve the mathematical expectation of that return stream over the long run, right? So that's why Jerry Parker says that trade that market consistently. So when that market gives you the return, so that you will be able to get that, right? And we also say that every market has the same mathematical expectancy. Okay, fine. But if the fruits of that mathematical expectancy, where there's going to be huge shifts from worst to best for some companies like Moderna during the COVID, you would want to incorporate that, because it can make a significantly positive influence in your portfolio if you incorporate that at those times, and I think what I'm trying to say is just, there's an element of hunting those outliers, and sometimes some opportunities, because COVID wasn't a short experience. It has been quite a long experience as well. So I just wanted to highlight that, because we are trading stocks now, right, in the trend following universe, and trading stocks is anything else but classical. I hope you would excuse me saying that, but Jerry Parker wasn't trading stocks in 1980s. It's just he and a few other experienced traders have come up with, let's trade the stocks at some point in their careers, and we are doing that. And while we do that, now the thing about the stocks is, my broker provides me 10,000 plus stocks. It's just not like 50 commodities or 200 forex or 20 or 30 credit instruments. There's more than 10,000 stocks, and of course, when the world switches from one black swan to the next black swan, things happen. There's a war, then there is COVID, then there is bear markets, so each of those experiences actually will lead some of the stocks to, some of those large caps give a lot of opportunities to be shorted, and these opportunities might be different. In 2008, for instance, I mean, you would be much better off to short those financial institutions in 2008. I'm not only talking about 2023, but who wouldn't want to be shorting those financial institutions in the middle of a global financial crisis? And if you wouldn't have the right number of stocks, it might be the smartest thing that you do to be able to add those, to be able to capture those outliers. And if you don't, if your portfolio construction was some reason missed those financial institutions in 2008, and I think you would rather add those stocks before eating your dinner and just short those stocks. That's what I think. But I might be wrong in some of my points as well. Thanks a lot, Funny.
Hi guys. Hi Jerry. Hi everybody. Yeah, very interesting discussions today. Um, on, I'll try to remember what I wanted to say from the beginning about the risk of ruin. So yes, I agree with the wider picture that Alp represented. That everything eventually ends. So and there are many layers of risk that markets are exposed to that are existent, and they're there, and nothing is ever zero. And I would go to the extent that if we extrapolate our philosophy that the tails of distributions are much fatter than humans expect, um, I would even go so far to say that all these things that we're calculating as 1% or less than 1% or much less than 1% probability of happening, my strategy stopping working or trend following stopping working or this or that, the layers of uncertainty are so vast and infinite that I myself personally, I put those probabilities to 10%, minimum 10%. So everything, there's nothing that I'm certain more than 90%. 90% is the maximum that I will be certain on anything. And I'm including everything. That's philosophy, that's strategies. So I would never say, this is it, this is the end, I've reached it, this is the truth, which is 100% sure. No. And the more I learn, the more humble I become. This percentage has grown. So that this 10% of being wrong in everything has grown from 1% from 10 years ago. And the wiser and more experienced I become, this percent grows. It doesn't shrink. So the more I know, the more uncertain I am about the things I know. And that includes trend following, that includes our strategies, that includes everything. So if you ask me, what are the odds that my strategy stops working or even goes to zero, I would say definitely 10% or more, not less. And I am allocating capital to it accordingly. So that's why I don't have everything that I own in it. That's why there's hedging on different levels. So this humbleness keeps you on your toes. When you're absolutely not sure about anything, you're never putting all your eggs in one basket, because no basket is more than 90% sure that it's going to be there, it's going to do its job. To the extent, and this is also connected with now the other things that we're talking about, the universe and decisions that we're making. So we don't have to go as far as predicting, markets stopping working or the whole planet going totalitarian Soviet Union style planned economy, and when markets don't exist, and of course there's no prices and there's no trend flow. We don't even have to go that far. Even in multiple scenarios in which markets do continue to exist, there are many modalities of these markets existing which can throw your strategy out of whack, to which your strategy was not prepared to handle. And that's why when we say trend following will always work, what we're saying is fat tails and trends will always be there. But whether our way of capturing them and our way of profiting them actually profits from them, it remains the question. So as the world changes and the modalities of the world and price action changes, there are infinite amount of ways that markets can move and produce fat tails and do stuff to which our strategy is not adapted, to which we thought it was, but it's not. And so that's another possibility. So where I'm questioning, I hear a lot about fixed universe. So Jerry wants to keep a fixed universe and be consistent, but the universe is never fixed. Markets keep being added. The universe is not constant, and so this addition is done randomly. So you have 50 stocks, then 100 stocks, then 150 stocks, then other markets and then other markets. The way that this portfolio has changed is random. It's not strategic. It's not statistical. Out of 10,000 stocks in the world that you could trade, the way you build a universe from 50 to 100 to 300 stocks, it's totally dependent on some random walk and random search. And I would like to ask Jerry a question. If the portfolio as it is, the fixed portfolio as it is of 300 markets, if for some reason in a 30-year backtest it showed no profits, or it was flat, or it was going down, would you trade it? I heard that Jerry says he picks the stocks, he doesn't care about the backtest. He has longs, randomly chosen longs, randomly chosen shorts. I have no idea why are these in the longs portfolio, the other ones are in the shorts. Maybe they look better on the chart at the moment of picking, they look more shortable or whatever. What is that criteria? It's not systematic, it's random. And my question is, for a given portfolio of 150 stocks, half of them are hopefully picked for longs and half of them are picked for shorts. If you backtested that portfolio over 30 years and for some reason the strategy is showing flat or down, would you trade them? Would you add them to the portfolio thinking, oh no, they were not profitable last 30 years, but there's no rules. I'm applying my rules equally across everything. I don't need for previous things to be profitable, but I hope that over not 30 years, but over 60 years, the statistics is going to work out and my sample size is going to eventually prove. So my question is, how do you add and build this portfolio in a random way without backtesting, hoping that all markets are the same, even though a backtest may show that they aren't? Because I can imagine, this is how I also connected with how I measure robustness of a strategy. If out of 10,000 stocks, you pick a portfolio of 150 randomly, there's like millions of those portfolios, millions of perturbation of 150 size portfolios out of 10,000 stocks. If half of them are not profitable with your strategy, half of them are barely profitable, and only 10% show some profit, would you just go ahead and still randomly pick 150 out of 10,000 and trade them for the next 30 years? There's a big uncertainty here. And this also reflects whether the strategy is robust. But now, by all means, if a strategy is really robust, and if 95% of those millions of portfolios of 150 stocks, so there's millions of portfolios, 95% are all profitable or positive zero or whatever, by all means, then pick random 150 and hope you're somewhere in a good part of that distribution over the next 30 years. But if that distribution of equity curves has a large part that goes down, like a large part of those millions of equity curves of all possible 150 stock portfolios, if a large part of those which are trading your strategy over the last 30 years, if a large part of them are going down and ending up negative, I wouldn't be so sure that blindly just looking at the news and reading at the news and looking for some discretionary way of decorrelation and adding these 150 stocks, it has some statistical expectancy 30 years going forward. So this was one thing about where things could go wrong with this approach, and also with risk of ruin. Because how long are you going to trade these 150 stocks if they if they're 50% of your portfolio, they lose money. So yes, you're down, you cut size. Now we're going to the next level on the portfolio level. The discretionary aspects of sizing of your trade level. There's discretion here. That's being exposed to risk. I can see a world in which, and we're talking about risk of ruin and large drawdowns, the Mulvaney 100% drawdown. It's very possible that you can have a strategy that the world doesn't have to end. The strategy is still showing some positive expectancy, but that expectancy is shifting in a way that as you lose money, you cut size down. You're down 10%, you cut down 20%. But then the strategy improves and you go up, and then you now increase size again. But then it goes down. There are ways and strategies where there are strategy with a positive expectancy, albeit worse positive expectancy than before, than in your backtest, can whipsaw you to almost zero like that. So there's no, basically what I'm saying, there's no free lunch. There's no way for you to guarantee or there's no consistent way with risk management and whatever to cut down your risk of ruin significantly. The markets can throw you a curveball in which your strategy, as you designed it, and your discretionary ways of protecting against drawdown will actually be detrimental, will draw you down faster than if you don't have them. And I'm speaking this with experience because I've done stuff like this before. So this is what else was I going to say? So yeah, so this is also connected with the risk of ruin. So in terms of I'll stop now.
I think a good method for characterizing the risk of ruin. I mean, I to pay homage now to Jerry after I ribbed him a little bit earlier. I look at the kurtosis of the distribution just even over just the last 5 years. I mean, it's low kurtosis. The skew is incredibly positive. So, your sequence of returns risk, so to speak, your time in the markets. I know we're talking philosophically about super long term risks or whatever. I mean, all you can do is have positive skew. Have manageable sort of I guess I never pronounce this right, but platykurtic distribution of returns relatively, at least especially in the mutual fund. But that to me is all you can do, and the rest is a leap of faith.
I deserve a very big pat on the back for not interrupting. Absolute. Very good. I was agreeing with a lot of what you were saying there. You seem too concerned about my particular strategy. I think I want to maintain consistency in how I choose all the markets, just not stocks. I would always have to catch myself. I'm better than everyone else, but everyone else is a tremendous failure that I've ever talked to as it relates to discriminating against stocks. So what I want to do, but even I'm not perfect, and so I have to watch myself where I treat the stocks and the futures markets differently for no good reason. So in the same way that I want to choose the markets that I trade in the futures, the currencies, commodities, and interest rates, which is just to look at diversification and liquidity and try to trade as many different markets as possible. I'd go way out on a limb on some of the commodities, South Africa, Brazil, some of the really thin ones, milk, rough rice, and just to get more diversification in my portfolio, irrespective of the back test. Now, I won't go out and optimize the back test and only include markets that have performed historically in the past. I think I don't kind of agree that that is the test. I think that you absolutely was saying, like, you were making too much of a claim. I think that if it was profitable in the past, it's going to be profitable in the future, or something like that, and vice versa. So I don't want to do that either. I want to include as many markets as possible, but inevitably, it's kind of silly. I try to make fun of this as often as possible, but someone was talking about it earlier. Oh, Alp was. This idea of, there's 50 stocks, there's 50 bonds, we're going to trade those, 50 currencies, I'm going to trade those. There's 50, roughly, commodities, I'm going to trade those. And there's 20 million stocks, so there's different rules. Okay, whatever. But I'm just saying is that I don't know why CTAs get so paralyzed when they're faced with even more options, but you just got to suck it up and try to build a very diversified portfolio in the stocks and take one or two from each sector or something like that, or try to get a bit more creative and dig deep into what these companies do, which is what I try to do. And, this is, what do these companies do? They're in the same, all 3 or 4 of these companies are in the same sector. They're labeled, there's a lot of labeling going on. These companies can choose the sectors and how to describe themselves, but I like to dig a bit deeper and say, okay, this company is asphalt, this company is aggregate, this company is cement, and versus, well, I'll just take one or two from building materials. So I want to try to get some real knowledge about what these companies do to, there's not an asphalt futures market or a chicken futures market or a French fry futures market. So I'm trying to, get some different exposure from these companies. I think that it's not 100%. It's a little dicey, but it's where else we're going to go if we don't, for this diversification. So I do think that we need I did get off of this whole idea of discretion versus systematic. And I think that it's inevitable that we might as well give in and say, yeah, there is a lot of discretion. When we build these trend following programs, we are looking at back tests, and people can interpret back tests differently. And then they can choose different things they like about systems. So it is a bit of discretion in choosing the markets and choosing the systems. But then I think the key here is once you've used that discretion is to try to keep it as consistent as possible going forward and follow the rules and try not to to kick things out of your portfolio. I've specifically said I think that's the problem is when you put something in, try to keep it in unless it goes away due to liquidity or a buyout or whatever, the market just kind of disappears. And that happens in stocks, of course, and it definitely happens in futures as well. So then, but we want to keep it in there. We want to, but I don't think that I need to make sure everything works in the past and that I'm trading the best stocks possible. I think it's very difficult in doing a classic trend following back test to find markets that don't make money and they don't make good money. So I think it's very hard. Maybe you don't have enough data, and some of these companies and ideas are new, like Bitcoin, and I threw Bitcoin and Ethereum futures in there as well. And then, sometimes when you throw in these markets and they don't have a lot of data in the past, they immediately make a ton of money. That's happened to me a lot of times. So I do think that there is quite a bit of evidence that we are right in assuming that even markets that haven't looked good in the past or don't have a lot of data in the past, we can still keep assuming that the expectation of all those trades is going to be pretty much the same as the trades we have in our portfolio. I think getting rid of all the grains after 10 years or 15 years of no profits is logical, but it didn't work out well. And I think philosophically, you don't want to do that. And I think sometimes the philosophy of it is going to work much better than the specific back test. I think getting rid of cocoa is in the same idea. It's liquid, it adds diversification. I don't think the back test per se in cocoa determines what cocoa is going to do in the future. The hallmark of trend following, the cornerstone of trend following is that what the best guess for the future in cocoa is the average trade of all the markets. Okay, I tried to take notes, but I may have left out. So if you want to follow up on that absolute, with just like a couple of questions so I can get right back into it.
Yes, that's a very good explanation. And that's why I posited my statement with saying if. I'm not necessarily saying that what you're doing is wrong. I think what you're doing is, my point is, if I try to present it most carefully, is that to the extent that your strategy, you have confidence in your strategy that whatever markets you throw at it, overall and over the long run and statistically, it's not going to get discombobulated and it ends up money, then yes, by all means, you are free to randomly choose markets, because over time you expect that all markets will, no matter which 10, 150 or 300 markets you choose out of all possible, over 10 or 20 years, you would expect all of them to make the same performance. So my caveat here is only, what if you have a strategy. And there's definitely strategies like that. There's definitely strategies. So, and this is how I quantify robustness. So if your strategy performs okay, or makes okay money, or the equity curves look equally tilted, so the branches of equity curves going upwards, like with any 20 markets you choose, any futures, any stocks, you just throw 20 markets on your strategy randomly out of possible 10,000 markets that you can trade. And most of those, all possible 20 market portfolios perform similarly, then by all means you have a very robust strategy, and you are entitled, because you have built such a robust strategy that is able to generalize behavior in such a over such a vast universe and produce a similar performance over a 10 or 20-year period, then by all means you're free to choose any 20 out of the 10,000 possible markets you can trade. But if you have a strategy which, when you apply it to these quintuples or whatever, a third of them go below zero, and only 2/3 of them have equity curves that end up above zero, then then that's a measure of lower robustness for your strategy, and that's a measure of the risk of choosing of which 20 markets you trade, because you have 1/3 probability of choosing 20 markets that over 20 years end up going straight down, like it was in the backtest. So this is connected with my quantification of robustness that I talked about maybe a month ago when I was here. So to the extent, so your ability to blindly choose any markets should be directly proportional with the robustness of your strategy, meaning should be directly proportional with the ability of that strategy to extract decent performance out of any 20 markets you throw at it. And
so I think that we've had this. Well, I know I've discussed it recently on the Spaces, and I don't know if you were on then, but it may simply just be that we have a different definition of, or maybe there's multiple definitions of robustness, I guess. But I prefer mine, which is that one entry, one exit, and a stop loss, and which was going to produce a lot of, as many as humanly possible for me, sample size of trades. And so I think even I gave this example that the of a system that is not profitable. Let's say for instance it's too short term. My opinion, right? That's what you want to stay away from. Nothing shorter than 100-day look back. So let's say that it produces 10,000 trades. I think and the back test says, oh, it's really not that good. I think it's very robust by the mere fact that it has all those trades. And the sample size is large. And so I think I do all I can to get as large a sample size as possible, but you have to walk the fine line of, I'll get more if I trade shorter term, but then the system based on the back test is going to be worse. So you have to find that sweet spot where you have a decent sample size, but you're actually making money. Another thing too, I wanted to mention, I did write this down on your previous comments. Yeah, I think you mentioned something about. Well, anyways, I'm not sure if this is what you meant, but I don't cut back. I have this cutback rule. I know about the cutback rule, but I've gotten really conservative with my money management as it relates to the number of markets I'm trading, taking the small bet size, and I have reduced my overall risk budget, from like, oh golly, 12 units to down to 5 or 6 units. And because I know that even though I have in my back pocket, and then I use this incredibly, for me, it was a big improvement over my my trade level calculation using closed trade equity. And I kind of tweaked it a bit to where it's very conservative. So I'm doing everything in my power not to use this cutback rule, because I know the cutback rule has no sample size. Thank God it doesn't have much of a, I don't want it to have a sample size. I want it to have a sample size of 0. I've never had a drawdown. How fun would that be? You never have a drawdown that requires this cutback rule, because the cutback rule is not a system rule, and the cutback rule has hopefully a very low sample size. It's never had to occur. And when I have implemented in the past, as I've said, it's been at the wrong time and it's hurt my performance. So I'm doing all I can not to use the cutback rule in order to stay in the game. But I guess I will use it if all of these other measures that I already have in place, if they have a tendency to not work that well. I agree with you totally on the parts that I agreed with, which was probably 30 minutes ago. This whole idea of being humble and not assuming too much from these markets and only having 90% confidence. I agree with that, those feelings and thoughts as well. And I was on I think on these spaces at one point in time, advocating to people that essentially, how is this going to be manifested? Well, by not putting all of your money in your trading. Take money off the table. Put it in your home or put it in your bank account or put it in gold or something. But yeah, you don't want to keep funneling 99% of your net worth into your trading. I think that that's true, but these are not my original thoughts, of course. Richard, you're too quiet.
Just listening, Jerry. It's interesting about the discussions about robustness. So the way I view robustness is when I hear these terms, what I tend to do is I say, right, rather than worry about the term itself, let's see if we can adopt a process that we can apply to measure robustness. So robustness to me is 2 factors. One is the ability to withstand historical market events and survive. That's sort of like a statement of endurance, your ability to find that your systems that you deploy don't fail. So the way I do that is I say, right, I've got a simple trend following model. I've got a particular back test of, say, 40 years for a particular market. I'll say, and of course, my models normalize each market by ATR, so we can trade all those markets the same way. And then I apply that system to the first market. That's the primary market I'm going to be trading on. And then I'll apply that same system across every other market in the portfolio. So what that's doing, if we can imagine, we're normalizing our process so that we're applying this strategy across all of our particular markets on the basis that outliers basically are universal principles found in every market, but we're not relying on the unique signature of any individual market. We're looking at this general principle called outliers. So by applying that model across not only a single market of 40 years, but across an entire portfolio of, say, 60 or 100 or whatever markets, you are applying that same model to alternate histories, exactly the same way as a trader is navigating into the future, because we never know what the paths of the future are, but we know that they're many possible paths. So what we do in the robustness test is we apply that model across many possible histories. So, maybe 100 histories. We're normalizing all of the volatility of those individual markets so we can trade them all the same way. Once that's passed the test, we know that that's a robust model because it's robust in its capacity to withstand the events that history or these numerous possible histories has presented. So at least from the basis of the history, we know that it hasn't fallen over. That's as best as we can get with our robustness statement. But there will be possible histories that we haven't seen in our back test that we have no knowledge of how our system's going to perform. But at least we've tested it across a huge array of different possible alternate histories of, say, 40 years or whatever, capturing as many different regimes as possible in each market with our universal models. Once that's applied, you can say that your model is robust. It's like a four-wheel drive as opposed to a Formula One. It survives. You notice the equity curves of all of your markets, and you're looking for a general slight positive expectancy across all those markets. You don't want any critical failure event on any of those market histories, because that tells you then that there's a weakness, a robustness weakness in the return streams, which can compromise your portfolio when you're going into an uncertain future. That's the first stage of robustness. The second stage of robustness is to recognise that markets are adaptive in nature, complex adaptive systems. So once you've passed that test of your models across all of those different markets, you then need to say, yes, but the future may be different and the markets may be different to what history is presented. How do we make these models adaptive? And that's where I apply what I call an adaptive process on top of the robustness process to then say, not only are my models robust, that's the first criteria, it's a conditional statement, but there's an and there, and they're adaptive. In other words, from the possible array of systems that I apply to these multi-markets, I then say, right, of that selection, now let's look at its adaptive ability. Let's look at how has each system performed over the last 10-year window or 15-year window. So initially we were dealing with a data set of 40 years. Now we're looking at 10 or 15 years and looking at the characteristics of those markets to do our selection criteria. So what we're doing is we're saying, right, I recognise that I've got finite capital. I therefore need to reduce the number of markets I trade because physically I cannot trade that with my level of capital. What is a process that I can apply to use as a selection basis? And that's where the adaptive process comes in to restrict the return streams generated from that ensemble of different histories to say, this is a selection I'm going to trade, because not only has it passed the robustness test, but also it's displaying this adaptive nature. So I'm always fighting with my ability I'm always looking to progressively increase my diversification. That's a general rule I abide by. As small bets as I can go, as wide a diversification as I can get, both in market and in system diversification, but recognise that there are these finite limitations of your capital and your broker restrictions that limit you to achieve this infinite diversification potential. So you need to therefore adopt a process of selection which tries to avoid hindsight bias. And so this process I'm applying, what I'm calling robustness, is a two-phase process of not only being robust, able to stand up to the elements of what history is presented, but also its adaptive quality. That's what restricts me down to a universe to trade with.
Richard, can I ask you a question? All of this depends on that the price movement characteristics remain as they have usually been, meaning that there are trends, right? I mean, do you believe, for example, I remember when I was on the trading blocks forum, there were some guys trying to prove that trend following worked with random series. So you think that the process is so robust as to work in something close to random series or something like that, or it works given that prices move the way they always moved in history, which will be with trends, and that's something that has to happen. If not, robustness is lost.
Look, I certainly don't believe the markets are efficient. I think they are almost efficient, but I do think there's a weak edge that can be extracted. And the reason I believe this is that every long-term data set of market data I've examined has this leptokurtic tendency. They all have these fat tails. They all have also peaks of distribution. So there are two elements of trading that can survive. One is a convergence style that's harvesting from the peaks, and then there's the divergent style harvesting from the tails. Convergence style styles are ephemeral in nature, very short term. They're timing dependent. You need a concentrated strategy. They're a totally different ballgame to what we're applying here in our trend following world. With the tails, we apply a very diversified process, focusing on these outliers that we know exist in the long-term data sets of every liquid market, at least I've examined. That's actually one of the things I do. Before I select a new market to trade, I need sufficient data to justify that it's got this leptocratic tendency. And if it does have that, I know that it has a propensity to offer outliers. Not guaranteed, but there is that propensity there. And that's why I therefore apply a universal principle to say that if outliers exist, I need these loose pants models, simple design models to capture that through a simple process of cutting losses short and letting profits run. The nuances associated with that are quite vast. It sounds a simple process, but the workflow process that I do is highly nuance driven. And I do believe that trends have changed form over the course of time. So back in the 1980s, when I've examined the trends that existed back then, I think they were a cleaner form of trend. There was less noise in them. As we sort of move on into the sort of 2010s up to the 2020s, the trends are still there, but they're much noisier. There's much more volatility in them. And how I'm justifying that is I'm saying, well, the nature of participation in the market has changed. We've got a lot more different types of trading method now being deployed by institutions and all of these different participants that is making trends less clean in nature, less precise. So, effectively, my models need looser pants as I'm going into the future, as markets sort of become more mature and the nature of participation becomes much more dense and lots more different types of activity. Because I believe that it's the participation impact that's actually causing these trends. So I'm sort of going back to that Jean-Philippe Bouchard, talking about what causes trends, and I believe it is the collective participant impact and the nature of sort of ecosystems in the market. Different types of trader styles create this trader impact, which, and on a collective basis, really amounts to sort of large price movements. So that's how I'm viewing it. And I just recognize that markets have got much noisier, especially the liquid markets that I'm trading over the last 30 or 40 years. So you do need an adaptive process and you need a robust process. So that's why I've focused on those two elements in my process to then decide how to select my portfolio from that.
Richard, can I ask you a question about this adaptive process that you're saying? So I'm assuming, I don't know the details. So I'm assuming you're basically, since trading all systems with all parameters in all markets, it's too many instances, so too many system market pairs, you have built an adaptive system which kind of picks the best performers over the last 10 or 15 years, maybe the top 20 or 30 system market pairs, and you trade those for 1 year. Then the end of the next year, you kind of rank. So you're basically trend following equity curves, picking either the best or both best and least correlated equity curves, and you're building a portfolio for the next year. If that's the case, and you can answer it, and even if that's not the case, even if your process is different, and I'm sure you've thought about this, you are opening a Pandora's box of added complexity and risk of overfitting, which is very, very big. I've played with stuff like this maybe 15 years ago, and my conclusion again is 90-10 division. Only 10% of these efforts may actually add a little bit of juice to the strategy. But the 90% of ones that will actually spoil it are just not worth the. And then you may come to your conclusion yourself. 5 years from now, you may come full circle and say this very nuanced and complex adaptive process, which very smartly puts me in the 20 or 30 system markets that were the best performing for the last 10, 15 years. So I'm outsmarting all these other guys who are trading all markets with all parameters, who don't care about this optimization. But I'm just warning and suggesting that there may not be as much juice and honey in that process as you may expect. You may have some, but I'm just warning that it may not be as much as you think there is.
No, I agree with that, absolute. And look, the reason I'm doing it is not because I'm getting more juice out of it. The reason I'm doing it is that I need to enforce an adaptive component into my systems because, you know, we've had these discussions on Spaces with Jerry where, you know, they found that in the 1980s and 90s, they were trading much more shorter term timeframes, and they decided at a later point in time that it was beneficial to them to start looking to the medium to long term look backs with their process. So all this is doing is it's saying, right, how do you therefore accommodate the need to alter your systems without having to sort of arrive at a discretionary point where you decide to change? In other words, how do you include an adaptive process that naturally sort of addresses that need in a systematic way as opposed to a discretionary way? So the reason I'm deploying this adaptive overlay, it's not simply selecting. So the adaptive overlay is a method of reducing the number of return streams that are eligible to trade. And the way I'm doing that is I'm saying, first, it must pass the robustness test of 40 years, as much history as I can throw at it, and in a multi-market capacity. So that's contingency one. Then that therefore produces a list of, you know, maybe 3,000, 4,000, 5,000 different candidates that all meet that robustness criteria. And when I'm saying candidates, I'm saying, you know, then I might be deploying 5 systems over 40 years, 100 markets or whatever. They've all met that test of robustness. Now, I can't physically trade all of those systems. So then I say, how do I reduce that selection so that, well, we know they're still robust because anything we select from that selection of robust candidates has already met that first criteria. Then what is it I'm saying to reduce that that number of candidates? And I'm saying, let's use a systematic process of selection based on performance over the last 10 or 15 years as a basis to simply reduce the number of candidates. So they've already been robust over 40 years. And now it's I look at the adaptive process. So what that does is it reduces the number of candidates from, say, 4,000 down to a manageable thing of, say, 500, 300 or whatever that I'm prepared to trade in my portfolio. Then it's a case of going through the portfolio compilation process and identifying what are the ultimate final algorithms I'm going to trade. And I'll do this process each year and allow each year all of the active trades that are present from a prior workflow process of the prior year are allowed to totally play out. So any active trades at the end of the year when I'm redoing this exercise, they're allowed to keep on trading until their conclusion. And then all I'm doing is I'm supplementing those algorithms with a new batch of algorithms that now includes an additional year. And that additional year, therefore, passes the robustness test. Now, it's not 40 years, it's now 41 years. And also, it's got this adaptive recency window of the last 10 or 15 years that might slightly alter the selection of algorithms. No guarantee. Most of them stay fairly constant. There's very little change in it, but it does give the ability to at least address if there is adaptation in the market. I've got a process that's going to pick it up. It's going to be a slow process. It's not going to be an immediate pickup. It's going to require sample size to detect, but at least the process is a systematic one as opposed to a discretionary one, because I don't like adopting any discretionary overlays into something that I can develop a process for that is systematic in nature.
Okay, so this goes, I understand, and that makes sense. So this also goes along the same measures of robustness I was talking about. So out of the 5,000 return streams, you're picking 500, but you know that any 500 of those 5,000 would pretty much show similar equity curves. You're just kind of wiggling plus minus a little bit back and forth in terms of performance, but you're basically saying 90% of those portfolio equity curves of 500 return streams out of the 5,000. So 90% plus of them are going to show similar angle, similar performance, and similar drawdowns and stuff like that. The problem
Exactly
would be
right. Yep.
exactly. So again, we are coming to my definition of robustness. So you already have a robust process and robust systems. All of your equity curves are going upwards nicely. You're just trying to kind of pick which 500, which equity curve you're going to trade, which equity curve of 500 return streams are you going to trade for the next year. But even if you, quote unquote, make a mistake, you're not going to be far off. You're not going to go from positive to negative equity curve, because most of your equity curves of 500 return streams put together in a portfolio are going to show similar performance, which is a measure of robustness. So you're basically showing that you have a robust system.
That's right, absolute. I'm actually having a podcast with Niels tomorrow where I'm talking about a process that can be applied, which sort of adopts this process in the selection of managers. And one of the, if, for instance, we are in the theoretical position of being able to evaluate, say, from a selection of 50 different trend following managers, we're able to select 10 of those managers, and we ran a back test using their validated track record of, say, 20, 30 years or whatever. And we identified that the optimal portfolio, with the benefit of hindsight, because we're using their validated track record as a basis to compile the best fund of funds of, say, 10 of those managers from a total 50 population, we get a particular hypothetical equity curve of that blend, which we can optimize to achieve the optimal performance from the available selection. So when you're selecting, 10 systems from 50 managers, you actually have to do, it's about 10 billion iterations of possible 10 sort of systems to actually then come up with the optimal portfolio with the benefit of hindsight. So what that's saying is that at this point in time, theoretically, with the benefit of hindsight, I can evaluate over the last 20 years, what is the optimal portfolio? Now, of course, we don't have that benefit of hindsight. So then what is a process that I can apply that converges to that solution? Now, that process I've talked about of robustness and recency is actually my method to converge to the optimal solution, because what I'm doing is it's a year delay process. So if I go back 20 years and I look at the available, CTAs at that particular time, maybe there was 57 or 47 or whatever, and I undertook that process, I'd come up with an optimal fund of funds of 10 managers 20 years ago. Then I'd run that unseen for the next year. And then the following year, I'd run that process again using the data available from all of the 57 or whatever fund managers at that particular time the next year that have a track record of, say, 15 to 20 years or 30 years. I'd run that process again. That therefore produces a different possible ensemble of 10 in the fund of funds. Now, what you find when you do that process year by year, you are not doing any hindsight bias here, because once you've done your selection of 10 managers, you're letting it run unseen for 12 months, and then you do the process again. But what you find through that process, each year you're doing it, you're actually converging to the optimal outcome that I explained at the beginning of this exercise, where with the benefit of hindsight, if we undertook that process, we could select 10 that were the optimal performers. You want a process that converges to the optimal outcome. And this is a process that can achieve that.
Richard, just one quick comment on this. You're saying without benefit of hindsight, but what you propose and what you are doing, and basically, yes, this, when I first thought about or read about this way of dynamically picking and just allocating to whatever, it was fantastic. I thought, wow, that's it. This is the holy grail.
That was excellent, Richard.
Okay, so what you're saying without benefit of hindsight, I would have a caveat on that. You are running a backtest basically on a meta level when you're doing this. So whatever your strategy of ranking, picking and choosing these 10 best out of 50 and then trading them once a year, like walk forward optimization. So you're basically doing a walk forward optimization, and every test that you do, as you run through the data once and then again, oh, this strategy of picking is better than the other one. This third strategy that now picks the 10 best is even better than the previous two. So the more you burn through the data, the more and more you actually get the benefit of hindsight, even though you're doing walk forward optimization. Walk forward optimization does not save you from overfitting and from hindsight bias. So this is the comment that I was going to make.
Yes, but what I'm doing is, so I'm doing a process at a point in time, say in the year 2000, I'm doing a back test based on the data available from 1980 up to 2000, say 20 years of data of the CTA managers. Then I'm running this optimization process to say, of that selection of managers, which one am I going to choose to run for the next year unseen? So the process is a backward-looking process that's then selecting 10. Now, for the next year, I'm running it unseen. So all of my ultimate final results are all unseen data. So it's just the selection process is using a backwardation method that's basically looking back in time to identify the robust candidates in a selection of, say, 10 from 50, and it's selecting what has performed in the past. It's not making any assessment about what's happening in the future. The only thing I'm doing is I'm saying the validated track record is enough of 20 years to say that the candidates I'm selecting, if there is a degree of non-random sort of robustness in that selection, this process is going to pick it up. But I do recognise that it inherently has the ability to be a random process.
Yes, so that's what you just described has a name. It's called walk forward optimization. If you search for it, and there's a lot of literature on it. So yes, I agree. So only when you go past in the history, you're only looking at past data to decide what you're going to do for the next year in the past, next year in the past. And so, but when you're looking at that past data in order to decide what to trade for the next year in the past, you are choosing you're testing a strategy. You are back testing a strategy of picking those 10 best. How do I pick them? Do I pick them best sharp? Do I pick the top 10? Do I also look at correlation? What is the look back? Do I look back 10 years, 5 years, 3 years? Which parameters do I choose to pick the 10? So you're basically building a strategy picking strategy, which you back test on historical data. So you are looking at the 10 years in the past. So let's say from 2000 to 1990, and you're trading from 2000 to 2001. So you're optimizing walking forward. So you're looking backwards, trading it forward for 1 year, then looking back another window of 10 or 20 years. All these parameters that you are choosing for your strategy testing, strategy picking strategy, they are subject to overfitting. There are infinite number of strategy picking strategies. The 4, 5, or 6 that you test, the 4, 5, or 6 that you test are strategies that are working the way you pick them. If you test 300 other strategy picking strategies, they may show not only worse performance, but they may destroy your strategy. They may be worse than just trading all 50 at all times. So again, you're opening a Pandora's box of overfitting, which affects robustness in a negative way. And it's measured by the amount of all possible, looking at the universe of all possible strategy picking strategies and deciding, if only 10% are improving my performance or not destroying my strategy, but 90% are actually worse, giving me worse performance than uniform distribution without picking or even destroying my strategy, then you're actually adding a very non-robust segment into your overall strategy building strategy. There's a huge risk of this that you need to be aware.
Yeah, look, no, I take what you say on board, but the example I was giving you was based on a fund-to-fund structure. So I'm using the program managers, and the way I'm compiling those 10 that I'm selecting is not 10 individual strategies in isolation. I'm looking at the 10 strategies as a consolidated portfolio for a fund of funds. So my measure of each basket of 10 opportunities is based on the collective position of those 10 funds and their overall risk-adjusted returns that they produce over that historical record. So I do recognise that, look, overfitting is a curse that is incredibly hard to avoid, but one of the things I do is I'm making sure that I'm using a very large data sample, using many years of data to try and reduce the propensity to overfit. I'm using, when I'm applying my own models, my multi-market test is a way to ensure that they're not overfit to any individual market, but they're sufficient to capture the outlier properties that exist generally in the market. So I am aware of this overfitting curse. I know that it's almost impossible to avoid it if you're using any form of selection method, but inevitably with the infinite array of options that we possibly can select from, you ultimately do have to make a selection process in a vast array of different processes that we deploy with trend following. We ultimately do need to select our universe. We need to select the systems we trade. We need to select the parameters we choose. So that selection process inevitably incurs some sort of overfit element into it, but I try and adopt processes that overcome that ability to overfit.
Hi, Richard. Can I say something? I read your paper on how you constructed that selection process. Found it very interesting and practical. And what I added to that, I made an exercise about that. What I'm trying to use as a filtering layer, so to speak, is to also look at how the risk-adjusted curves of those fund managers selected developed over time. Whatever you think risk is, MAR, Sharp, etc. What I try to do is try to pick an extra layer, and that is that managers are constant in the way that their risk-adjusted return goes over time, meaning that they don't reduce the risk-adjusted return, or they didn't reduce the drawdown or volatility too much. I don't know if that's right or not, but it kind of it's a style drifting filter that I use over your method. I'm not sure if it's 100% additive or good enough, but it's something that I use when I look at managers in the cases that you're trying to do the fund of funds exercise.
Yeah, cool. I suppose I don't have anything to say on that apart from, just make sure you can hopefully over a process validate those assumptions. But yeah, there's lots of different ways to skin the cherry, but I do like the idea of adopting a process to achieve an outcome as opposed to selecting from an outcome. So, everything we do should be process driven as opposed to a position of a discretionary sort of selection of return streams from, a discretionary brain. I don't think is a way to achieve it, because that's where I do think we get into overfit problems and the issues of selection bias, etc., that occur in that. So I'd say it's got to be a process you apply. It's got to be a regimented process, one that you hopefully can validate over the course of large data samples. So the one I'm doing with TTU, I've run it now for this process over a 22-year period. It seems to stack up very well, and it certainly seems to converge to that optimal solution that I was talking about if we did have the benefit of hindsight bias.
Richard, I want to ask you a couple questions and a follow-up. First of all, what do you mean by converging towards an optimal solution? I have no idea what that actually means.
So what that means, Jerry, is imagine today if you could run a back test using your available markets, and you say you had 100 markets. Say today you ran a back test of those 100 markets to identify systems that produce the optimal outcome. And this is a case of clear overfitting. In other words, you have the benefit of hindsight and you can produce the optimal best back test that is possible through the possible number of combinations available to you in your process, the number of permutations of your variables, etc. You select the best possible choice at a portfolio level. So that's with the benefit of hindsight. Everyone can do that, and that's what most people do when they do a back test. They squeeze out these magnificent back tests, which are fantastic, glorious things, and they never stand up to the test of time. They always fall over, and that's because they've been overfit, or there's been a selection bias applied based on a historical test that selected the best outcome in accordance with history, and the future is different, and it doesn't stack up. So what I do, therefore, is say, all right, recognizing that you can't use hindsight bias, is there a method that you can deploy each year that progressively converges you or converges you to that optimal solution? And yes, there is a process. It's a lagging process, but you can do it by the way we apply a process. So, I was saying, if I could, at this point in time, undertake the back test, I'd get this optimal solution. I say, but how can we apply a process that can achieve that converges to that, but is something that doesn't use the benefit of hindsight? So if I go back 20 years and I do that same experiment 20 years ago, I'd get an optimal solution based on what was available 20 years ago using the past 20 years of data. That produces a result. And then I run that result for 1 year without on unseen data. The next year I do the same process. The next year I do the same process. The next year I do the same process. I get up to the current day. And when I do that process again, I achieve that optimal outcome that I was just explaining to start with, because I run that process at this point in time now, but it lags by 1 year. That's the only thing. It lags by 1 year. So this converging solution lags by 1 year. Does that make sense? Apologies, trend followers. It looks like Jerry's had technical issues, so unfortunately we had to end Spaces at this point in time. But Jerry will be back next Friday, so see you all then. Cheers.